Welcome to another episode of The Riffle, a podcast series brought to you by 10 Leaves. Okay, let's unpack this one. We've got a really powerful source today, and it's incredibly timely. It's a direct letter, almost like a pretty tough report card, from a major global regulator. We're talking about the Financial Services Regulatory Authority, the FSRA, from the Abu Dhabi Global Market. And it's dated October 10th, 2025. This isn't just general guidance, is it?
No, not at all. This is specific, detailed feedback sent straight to the executives, the people running virtual asset service providers, or VASPs. It lays out the exact gaps they found in crypto anti-money laundering, AML, and counter-financing of terrorism, CFT compliance.
They're direct findings. Why now? Why this deep dive into VASPs?
Well, it's fascinating, actually. The FSRA explicitly calls the VASP segment an emerging area of risk. And that echoes what we're hearing globally from bodies like FATF, the Financial Action Task Force. It's all driven by the sheer speed of innovation in virtual assets and, frankly, the potential for misuse.
Right. Constant innovation means constant new risks.
Exactly. So our mission here is to really distill what the FSRA found. We'll focus on the concrete weaknesses across 4 key areas: customer due diligence, CDD, transaction monitoring, targeted financial sanctions, TFS, and the big one, travel rule compliance.
Okay, so this should give everyone listening a really clear view of where the regulatory spotlight is shining right now in the crypto space.
Precisely. Actionable insights based on direct regulatory feedback.
So let's start high level. What was the overall feeling from the FSRA? Did they find firms were just completely unaware of their obligations? Or was it more subtle, like knowing the rules but just failing to follow through?
It was definitely the latter. The review found that, generally speaking, VASP firms do show awareness of their AML CFT duties. They have the policies written down, the manuals are there.
They tick the box on paper.
Kinda, yeah.
Yeah.
But the report really digs into significant weaknesses in execution. It's like having the blueprint for a house, but then using shoddy materials or cutting corners on the build itself.
Ah, the execution gap. That makes sense. So the foundations are shaky, even if the plan looks okay.
That's a good way to put it. These are practical, real-world gaps that seriously limit the sector's ability to effectively spot and stop financial crime.
Okay, so not just a paper exercise problem. What were the main areas where this execution failure kept showing up? The big themes.
The FSRA highlighted 4 key areas, really. First, inconsistency and just a general lack of depth in customer due diligence, especially when dealing with clients who are maybe higher risk.
Okay, CDD weakness, number 1.
Second, weaknesses in their transaction monitoring systems. They weren't sophisticated enough or tailored enough. Third, a real practical misalignment with the travel rule. Big operational hurdles there.
And the 4th.
And finally, this is quite important, a failure across some firms to get their controls properly checked by an independent party, through internal audit or bringing in external reviewers.
Right, so no independent verification that the controls actually work in practice.
Exactly, not enough robust challenge.
So the regulator's message seems pretty stark then. Stop just writing policies, get practical, make it risk sensitive, document everything properly, and make sure it actually works.
That's it in a nutshell. They want to see frameworks that genuinely tackle the unique risks of virtual assets, not just generic compliance templates. Consistency, detail, and a real risk-based approach are key.
Let's get into the weeds then. CDD, customer due diligence. This is fundamental, right? Verifying who your customer actually is. Where did the FSRA find the biggest holes here, especially around, where the money comes from?
Yeah, this section, honestly, it highlights maybe the single biggest vulnerability they found. It really centers on source of funds, SOFIN, and source of wealth, SOW.
Okay.
The absolute core failure was verification. Very few VASPs could show they had strong, robust processes for checking this stuff out.
So are we saying if a client walks in, figuratively, and says, oh yeah, I made millions mining Dogecoin back in the day, the VASP just nodded along?
Alarmingly, often yes. Instead of asking for and getting independent proof, like, say, a tax return, maybe wallet transaction histories verified, sale documents, something reliable firms were found to be relying mainly on just what the client told them.
Wow, just client self-declarations.
Primarily, yes.
Yeah.
The regulator basically said VASPs were acting like they could just trust the client's word, especially for where large sums came from. And that's just not acceptable, particularly when you get into high-risk relationships.
Okay, that's a huge red flag. What about enhanced due diligence, EDD? For those higher-risk clients, maybe politically exposed persons, people from risky jurisdictions, were they digging deeper like they're supposed to?
Well, the EDD application had significant gaps, too. In those higher-risk cases, the extra steps taken were often described as limited. Or sometimes the VASP just completely failed to document what they did or why they decided the risk was acceptable.
So even if they did something extra, there was no proof.
Exactly. If you're onboarding someone high risk, the regulator needs to see the paper trail. They need to understand your thinking, your justification for managing that risk. If that documentation's missing, the control might as well not exist.
And basic governance. Did senior managers sign off on these high-risk clients?
Not consistently, no. The report points out specific instances where senior management approval wasn't obtained or, crucially, wasn't recorded before onboarding. And get this, in some limited cases, firms even failed to get basic residential address verification documents. That's like CDD 101, it's expected, it's mandatory.
So fundamental failures even at the most basic level.
It seems so in some instances.
Okay, so the message on CDD is loud and clear from the FSRA. It needs to be comprehensive, applied consistently, documented fully, and critically, use independent sources to check where the money and wealth came from. No more just taking the client's word for it.
Precisely. They need to build a real evidence-based risk profile, not just process a transaction.
All right, let's move on to monitoring the transactions themselves. Crypto transactions are unique, obviously. How did the regulator find VASPs were doing here? Were their systems actually catching suspicious activity effectively?
Yeah, this is where you really see the challenge of applying traditional finance AML thinking to DeFi and crypto. The problems fell into two main related buckets: the transaction monitoring, or TM, systems themselves, and the underlying risk-based approach, the RBA.
Okay, so the monitoring first. What was wrong with the systems?
Often they were just too simple. They used scenarios and thresholds that weren't really designed for crypto. Critically, they weren't aligned with the specific ways criminals might misuse virtual assets, the unique typologies.
So they might be looking for suspicious cash structuring maybe, but missing weird patterns on the blockchain itself.
Exactly that kind of thing. And a major failing wasn't just what they monitored, but how narrowly they looked. The focus was heavily skewed towards just the on-chain transactions. There was limited, or sometimes no, capability to capture the broader client behavior. Things like, did the client suddenly change their activity? Maybe they went from small, local peer-to-peer stuff to suddenly doing massive cross-border transfers.
Right, activity that doesn't match their profile.
Exactly. That kind of anomalous behavior, the narrative context, was often being missed because the systems weren't set up to detect it.
Okay, so if the monitoring tools are blunt or looking in the wrong places, the whole system is undermined. Which I guess leads directly into the problems with the overall risk-based approach, the RBA.
It really does. Because the RBA is supposed to inform how you set up your monitoring. The regulator found that the fundamental risk modeling was weak. For instance, the business risk assessments, the BRA, where the VASP assesses its own overall vulnerability. These were often quite generic.
Generic how?
Well, they lack detailed analysis specific to virtual asset risks. Maybe they didn't properly consider the risks of dealing with certain DeFi protocols or privacy coins or specific jurisdictions. And crucially, there wasn't always a clear link between this assessment and the actual controls the firm put in place.
So the risks weren't properly identified, meaning the controls couldn't possibly be adequate.
Right. If you don't know exactly what risks you face, how can you design controls to mitigate them effectively?
And what about assessing the risk of individual customers? The customer risk assessments, or CRAs.
Similar issues there. The methodologies used to score customer risk were sometimes undocumented, which naturally leads to inconsistent application. You can't have different teams scoring risk differently.
No consistency.
And critically, some CRAs just fail to include key factors. Things like the customer's stated business purpose, or how they were actually using the VASP's products and services. These are vital details for getting an accurate risk rating.
So you could end up misclassifying a high-risk customer as low risk just because you didn't properly factor in what they were actually doing on your platform.
Precisely. And if that happens, your whole AML system is fundamentally flawed from the start for that customer.
Before we get to the travel rule, which I know is a huge one, let's quickly touch on something from the General Observations Targeted Financial Sanctions, TFS. Were firms doing okay screening against sanctions lists?
Ah, yes, TFS, vital. The review found that controls here were often too reactive. They weren't proactive enough.
Meaning?
meaning firms sometimes failed to make sure their screening databases were updated frequently enough, or that their internal processes kicked in immediately when new sanctions designations were announced.
So a delay between a name being added to a list and the VASP actually stopping transactions?
Potentially, yes.
Yeah.
Sanctions lists can change fast. If your screening is, say, only updated weekly, or the system isn't set up for immediate alerts and freezing actions, you're running a massive regulatory and reputational risk every single day.
What does the FSRA expect then?
They expect active, near real-time screening protocols and the ability to immediately freeze assets or block transactions involving sanctioned entities. No delays.
Okay, that's clear. Now, the big one. The elephant in the room for crypto compliance. The travel rule. We've established issues with knowing the customer, CDD, monitoring their activity, TM, and screening them, TFS. But what happens when assets move between VASPs, especially across borders? What challenges did the FSRA see here?
Yeah, the travel rule, it's a massive operational lift for the industry. The awareness is their firms know they need to send originator and beneficiary information along with qualifying virtual asset transfers, but they pointed to huge operational and technical barriers. The main one cited is the so-called sunrise issue.
Ah, the sunrise issue, where the VASP in Abu Dhabi might be ready, but the one they're sending funds to in another country isn't. Their jurisdiction hasn't implemented the rule yet.
Exactly. It creates this compliance mismatch. But, and this is really crucial, the FSRA stance is incredibly strict here.
They're not giving firms a pass because it's difficult globally.
Absolutely not. This is a key takeaway. FSRA licensed VASPs are expected to fully comply with the travel rule requirements as laid out in their AML rulebook. And critically, they must apply these obligations to all qualifying transfers. There are NO de minimis thresholds permitted.
Wow, no minimum amount. So even a tiny transfer theoretically needs full travel rule info attached.
That's the requirement in the ADGM, every qualifying transfer. It fundamentally changes the calculus on cost and speed for small transactions, doesn't it? It imposes a significant operational burden.
Hugely. So what else do they need? Just collecting the info isn't enough, presumably.
Right. VASPs need clear, written protocols for what they do when they receive a transfer. How do they review the incoming information for completeness? And they need predefined rules for when they will process the transfer, when they'll suspend it while asking for more info, or when they'll just outright reject it if the information is missing or non-compliant.
So they need decision trees based on the quality of the data received.
Essentially, yes. They can use a risk-based approach, maybe considering the jurisdiction the transfer is coming from, but the process needs to be documented and consistently applied.
And what about the VASP on the other end? Do they need to vet their counterparty VASTs?
Yes, absolutely. Counterparty due diligence was another weak spot identified. Some VASPs were executing transactions or even forming relationships with other VASPs without doing proper risk assessments on them first.
So sending funds without checking if the receiving VASP even has decent AML controls.
Exactly. You need to assess the AML CFT systems of the counterparty VASP, especially if in a jurisdiction you consider higher risk. Otherwise, you're essentially importing their risk onto your own platform.
Okay. And this leads us to maybe the trickiest part of all this. Unhosted wallets. The self-hosted wallets outside the regulated system. Huge transparency problem, right? What did the FSRA find?
Yeah, this is a major challenge. The review found that almost all ADGM VASPs do allow transactions to and from unhosted wallets. And this inherently creates risk because getting reliable originator or beneficiary information is, well, difficult.
So they know it's a risk. Were the measures to manage it sufficient?
According to the FSRA, no. The measures observed were deemed generally insufficient.
Okay, so insufficient measures for a known high risk. What are they demanding VASPs do about unhosted wallets then? How do you bridge that gap?
They require a documented, risk-based approach. It has to be robust. This includes things like setting clear risk appetite thresholds, basically, deciding how much risk from unhosted wallets the firm is willing to tolerate.
Setting limits.
Right. And crucially, collecting and retaining sufficient information about the originator or beneficiary associated with that unhosted wallet. And this can't just be taken on faith. It needs to be supplemented by actual verification methods.
Verification methods? Like what? How do you verify who owns an unhosted wallet?
This is where it gets technically specific. The regulator explicitly mentions methods like the Satoshi test.
Okay, the Satoshi test. We mentioned it earlier. Can you explain that briefly? What is it?
Sure. The Satoshi test, sometimes called a proof of control method, is basically a cryptographic verification. The VASP asks the customer who claims to own the unhosted wallet to perform a specific action that only the true owner could perform. Typically, this involves signing a small transaction or a specific message using the private key associated with that wallet's public address.
Ah, so proving cryptographic control, not just saying, that's my address.
Exactly. It moves beyond simple declaration to actual proof of ownership or control. The FSRA sees this alongside enhanced transaction monitoring and using blockchain analytics tools as necessary steps to manage the risk.
Okay, so the bar is set pretty high there. It sounds like the FSRA is really pushing senior management across these VASPs to move past complacency. What are the immediate next steps, the marching orders?
The main expectation is immediate review and action. Firms need to take these findings, look hard at their own systems, and implement significant enhancements, like now. A big focus area they called out was training and awareness.
How so? Were training programs bad?
They were often found to be too generic, not tailored enough to the specific roles people have. What frontline staff need to know is different from what compliance needs, which is different again from what senior management needs to understand.
Right, role-specific training. Makes sense.
Exactly. The FSRA expects that, plus mandatory refresher sessions, and this is key effectiveness testing, quizzes, knowledge checks, assessments. Something to actually confirm that staff, especially those dealing with customers or transactions, truly understand the risks and the controls they need to apply.
So prove the training actually stuck.
Precisely. And ultimately, the responsibility for all of this is placed squarely on senior management. The report emphasizes that consistent, effective financial crime controls are absolutely essential for a secure business, and management needs to be actively driving these improvements visibly right across the firm.
No hiding for the execs.
None. They'll also be following up directly with specific firms where they have particular concerns.
Okay, so pulling it all together, this deep dive really underscores that the debate isn't if crypto needs regulation anymore. It's about how effectively firms are actually implementing it on the ground. The ADGM FSRA has basically handed VASPs a detailed checklist of exactly what needs fixing. From digging deeper into source of wealth with real evidence, not just claims, to implementing that travel rule strictly, no exceptions, no minimums, it really feels like playtime is over.
It does. And it leaves us with a really crucial question for the whole industry, doesn't it? When you look at the inherent difficulty of tracing funds from unhosted wallets, and you see regulators demanding quite intrusive verification tools like the Satoshi test. How quickly can the compliance technology, the RegTech, actually evolve to meet these very high standards without completely crippling the speed, the efficiency, and maybe even some of the core value propositions of virtual assets?
Yeah, balancing robust compliance with innovation and usability.
That's the tightrope every VASP executive is walking right now. It's a massive operational and strategic challenge.
A challenge indeed. Well, thank you for walking us through that. A really insightful look at where the regulatory pressure is building. And thank you for joining us for this deep dive. This has been another episode of The Riffle, a podcast series brought to you by 10 Leaves.